Let's talk about the financial crisis that occurred in 2008 and that led to the Great Recession of 2009 and 2010. So this week I'm going to just focus on what the financial crisis was and how it occurred. In the upcoming weeks, we'll look at the response to the financial crisis and then the impact to individuals. So there's some key questions that we should be asking. So why did housing prices rise rapidly and then fall? Why did the mortgage default and housing foreclosure rates begin to increase more than a year before the recession of 2008 started? Why did the default and foreclosure rates increase so rapidly? And why did savvy, long-standing investment firms like Bear Stearns and Lehman Brothers get into the market of buying risky mortgage-backed securities? And where were our policymakers when things were getting out of hand leading up to the financial crisis of 2008 and 2009? And then finally, what have we learned? Can this happen again? And that will be something that we'll talk about in next week and the following week. So the hypothesis is that it really boils down to about 5 or 6 issues. One is that there was something called loose monetary policy, low interest rates making it easy for firms and individuals to gain access to funds. There was a deregulation of the financial markets and financial firms. And then there was concurrently these new complex financial instruments that really nobody understood. And some people call it the model or the financial instruments that ate the economy. And then we had an unprecedented boom in housing prices, and that was really fueled by these subprime mortgages. Basically, anybody could get a mortgage and buy a house, even though they may not be have the income or credit rating to really justify being given a mortgage. And then the rating agencies really stood on the sidelines and basically rubber stamped these complex financial instruments as being at a much higher grade than they were. And then last but certainly not least is this issue of greed versus fear. So part of the balance that we need in a free economy is what's called the negative feedback loop, where people want to make money, so that's the greed aspect, but they're also afraid of taking risk. So if you think about risk and reward, the risk and reward issue is one where I'm willing to take some risk if the reward is sufficient, but sometimes things get out of hand. People are willing to take more and more risk, and at some point that the negative feedback loop breaks down. So typically we expect when prices go up, people buy less. But when we see a market where when prices go up, people buy more, we see that in the stock market sometimes, we see it in the housing market sometimes, then that tends to build up a bubble, and bubbles tend to burst, and that can create a big financial problem, which is what we saw in 2008 and 2009. So loose monetary policy, basically low interest rates. We were printing lots of dollars, making it easy for people to gain access to funds in the housing market. And that was certainly part of the problem. And we deregulated the financial industry, allowing firms to do things they had never done before. And one thing I should emphasize here is that the financial crisis and response is a very complex topic. So I want to give you just a high-level overview. Certainly, people have studied this extensively, and I'm not expecting you to be an expert on it. I just want to give you a general sense as to what happened and the general sense as to the response to it. So we had new financial products. Warren Buffett, one of the masters of financial investment, called them financial weapons of mass destruction. Basically, they were financial instruments like mortgage-backed securities and credit default swaps, neither of which we need to know, that people really, even savvy investors, didn't understand what they were buying up because people were making lots of money on them. So this was that chasing lemons. Prices go up, people make money, everybody wants a piece of it. And then the credit reporting agencies basically stood on the sidelines. Then we had this big housing boom. Prices went up dramatically. And this chart was done by a very famous economist at Yale. His name is Schiller. He studies the US real estate market. And here's 1890 back here. If you look over time, here's 100 years later, prices adjusted for inflation have only gone up 20%. Okay, we have our ups and downs, but over the long term, what his finding was is that it's a good investment, but not one where you make money. You basically keep up with inflation, make about 2% a year. Then all of a sudden we see this in a 5-year window. Prices take off like a rocket. And this is what we see. This is this irrational exuberance. This is greed overriding fear. This is the negative feedback failing. And this is a bubble. Bubble bursts, prices fall, firms are hurt. And so we see a big collapse. And also what we see is that was fueled by well-established investment firms and banks buying up these instruments that they really didn't understand. And that created a much deeper problem. So the role of the credit reporting agencies, their role is to try to not allow the financial instruments to be created that people don't understand, that are risky, without them understanding that they're very risky. But they somehow just rubber stamp things and indicated that they were a much safer bet than they were. And then the last is, and certainly not the least, was that we had greed versus fear. So all markets depend on negative feedback, and when that fails, we often see bubbles. And the financial crisis was unique, and that involved our core system, the financial market. So if it's just individuals, if it's just one small segment of the economy, that's one thing. But when it involves the financial system, which we depend upon to be stable, predictable, then that created an unprecedented problem. All right, so we'll look at this over the next couple of weeks. But at this point, what I want to do is just switch back to things that I expect you to do this week. So this week, I want you to, wrong folder. So just to reiterate, what I would like you to do this week is to take a look at the materials I've posted on market structure, oligopoly. So there's the slides and a few videos. The financial crisis part 1, there's some slides, but more importantly, take a look at these 3 videos I've posted. When you're done with those things, I'd like you to participate in a couple of discussion board questions, one on the financial crisis, one on oligopolies, and to complete the graded assignment on oligopolies. Now, graded assignments you can take as many times as you'd like, and I'll only count your highest score. All right, so thank you, and please stay safe.